Good morning. It is February 26, 2026. Global markets are currently paralyzed in anticipation as US and Iranian negotiators convene in Geneva for a decisive third round of high-stakes talks. This is not just a diplomatic meeting, it is a high-stakes poker game for the future of the petrodollar and the 2026 global inflation outlook. With the Trump administration's 10% global tariffs already tightening the screws on international trade, the outcome today, be it a grand bargain or a kinetic conflict, will dictate whether the global economy enters a new era of expansion or a brutal period of stagflation. Brent crude is currently hovering near $72, pricing in a modest risk premium, but analysts warn of a binary outcome. It is either a diplomatic breakthrough or a path to immediate escalation. To understand the gravity of this moment, we must look at the ghosts of crises past. History tells us that oil is often the trigger, but the dollar is the weapon. Let's look at three pivotal moments. First, 1979. The Iranian Revolution triggered the second oil shock. Crude jumped from $13 to $34 a barrel in months, a staggering 160% increase. The result was rampant inflation, forcing then-Fed Chair Paul Volcker to hike interest rates to 20%. This birthed the super dollar, but at the cost of a global recession. Fast forward to 2015. The signing of the JCPOA saw Iranian oil return to the global market. Prices collapsed from $60 to under $30 a barrel. This disinflationary relief allowed the dollar to stabilize and fueled a low-inflation growth cycle for the West. However, that stability was shattered in 2018 when the US exited the deal. We saw a safe haven flight back into the greenback, and oil surged 30% as geopolitical uncertainty returned to the forefront. Now, let's look at today's scenarios. Scenario A, the golden handshake. If a multi-stage deal is signed today, Iran could inject up to 2 million barrels daily into a market currently stressed by tariff-related costs. This would be a massive disinflationary gift, allowing the Fed to pivot toward rate cuts and taking the steam out of the DXY. More importantly, if this deal reinforces dollar-based energy settlements, it effectively neutralizes the de-dollarization narrative we've seen gaining traction globally. But then there is scenario B, the breakdown. If negotiators walk away, the war risk premium will explode. Analysts predict oil hitting $120 if the Strait of Hormuz is threatened, a waterway that carries 20% of the world's oil. For the dollar, this is a double-edged sword. While it gains on safe haven flows, it would force the Fed to keep rates higher for longer to combat energy-driven inflation, potentially crushing emerging markets under the weight of an apex greenback. Market participants are already hedging. Gold has surged toward $5,200 an ounce, acting as the ultimate barometer of fear. If Geneva fails, we expect a violent flight to safety. Traders are buying short-term straddles, betting on extreme volatility. If you are long on energy, you are betting on a collapse in diplomacy. If you are looking for a soft landing, you are praying for a signature in Switzerland. The lesson of the last 50 years is clear: the energy market and the US dollar are inextricably linked. Today, we are not just watching a diplomatic meeting, we are watching the recalibration of the global financial order. In this market, fortune favors the informed. Watch the headlines, but trade the data. The empire is striking back, and the weapon of choice is the dollar. I'm Eric, for Market Meridian Finance. Please subscribe my channel and we will see you at the opening bell.